Hello and welcome to FidelityConnects. I'm Glenn Davidson. As tech earnings slowly trickle out, it's clear companies are increasing their spending on chips and data centers. This could put pressure on earnings and valuations, but it is also laying the foundation for the next decade of productivity, automation, and new digital business models. So how is AI adoption evolving, and what do recent earnings mean for the outlook on US software and the broader tech sector? Joining us in studio to dive deep into this and more is Ben Holton, analyst and portfolio manager. Welcome, Ben. Great to have you here in the studio.
Thanks for having me. Always happy to talk tech.
Great, and we've got quite a few minutes to talk that. Ben, we should start with what's current in the news as we do this today, which is really around CapEx and companies perhaps spending more than they should, or they've spent too much, and the market's reacting. It's reacted negatively yesterday, today so far. What are your thoughts?
Yeah, I think it's an ongoing trend here, right? This isn't new this quarter. It's a building trend, but the problem is the numbers keep getting bigger. So we had the first hyperscaler report earnings this week. That was Google. Growth looks great. The problem is growth in spending is also big. And there is an ongoing debate around the ultimate kind of return on capital that these companies will get. And so far, the market's not seeing enough breadcrumbs to support this spend.
And there's also a lot of issuance of debt now from companies, which we hadn't seen before from a corporate financing standpoint. What are your thoughts on that?
Yeah, so it's interesting because we've got kind of a handful of the biggest companies in the world and most profitable companies in the world taking their free cash flow negative because they're spending so much on CapEx. They're funding that with debt, and in some cases, equity. You know, it's an interesting time to be alive, for sure. Seeing Google issue equity at this scale and size, Oracle's going to have to issue equity. They've announced that. They need to show the return, and that's what the debate is.
And so it's almost a bit of experimentation for companies to say, wow, we're in unprecedented times. Let's try different ways of financing this and see what the market reaction is as well. And there's certainly been more of an expectation from investors on exceedingly good earnings, isn't there? And there's punishment. We look at IBM, I don't know what it's trading at today, but what was it, a week ago or so, down 25% in a day. There's a lot of punishment that can be had.
Yeah, earnings season is started off kind of challenging here. You've got a number of hardware companies reporting great results, really fantastic growth. The problem with a number of these is expectations have caught up to the share price, and great numbers are no longer good enough, right? Everyone already owns those stocks. Finding an incremental buyer is hard. So you're seeing great quarters, kind of muted or negative share price reactions. Software land's been kind of mixed as well. You've got a few companies out there. SAP reported last night, ServiceNow earlier this week. You are seeing good enough quarters, but not necessarily enough to dispel the AI loser bear thesis that's hanging around software. Whereas others, IBM, and they're not the only one. There's a smaller company, Pegasystems, that had a similar call out in that AI is distracting their customers and pulling spend away from them. Unfortunately, that kind of confirms the AI loser thesis, and that's a bad spot to be. IBM had its worst day in its 115-year history. It's a pretty big milestone event.
Share buybacks are also down dramatically. And what do you see as the impact on the market for that?
Yeah, I think it's hugely split though. So for the big CapEx spenders, buybacks are down a lot because they are moving from buying back their own shares to buying GPUs and data centers and things like that. Money doesn't grow on trees. They're having to prioritize where they're spending that money. Other companies, software namely, you're seeing huge buybacks. I think Salesforce did the largest accelerated share repurchase in history, right? They aren't the AI spenders. They are producing free cash flow. Their valuations are quite low, and their response, for the most part, has been to turn to buybacks. So it's a very much bifurcated market on that.
That's very, very, very interesting. If we just read headlines and react to it, which is not a healthy thing to do, but a lot of people perhaps do, there'd be an impression that investors gave up on AI and are looking for new shiny things. Do you agree with that?
No, I think investors are mining for ideas. So NVIDIA has been an interesting stock because that was the poster child. Mm-hmm. And then the aperture kind of widened and we say, what's next? You've had a great run of stocks where people have chased the next bottleneck. Mm-hmm. So GPUs are taking off. What goes into a GPU? What does this need, right? Memory was a big piece. And then you saw a huge shortage in memory. That meant these companies could raise prices a lot. You've seen these stocks run hundreds of % year to date as investors piled in.
That's an interesting phrase, chasing a bottleneck. Could you explain that more? And what other bottlenecks are there? So I assume I think what you mean is, where is there the next extreme demand where we just don't have the production, but it's going to be needed? And that could be data center inputs, it could be chip inputs and beyond.
Yeah, so it's interesting because digital goods can scale infinitely and very fast. But AI is very much supported by a physical world, right? We need a lot of compute. That compute is very physical asset heavy. GPUs, data centers, power. As the demand scales, the digital demand scales, you and I using AI, companies using AI, that puts more and more stress on the supply chain. We need more of that. The physical production of those goods can't scale as fast, right? Like to build a new computer chip fab takes years and years and years. You can't just get more tomorrow. And that means there ends up being these weird pricing dynamics where if there's more demand, you can increase price more and more. And that's kind of the bottleneck you want to be at, or that has worked at least. Will it continue to work? TBD. Mm-hmm. But it's worked in that if you have a tiny component inside of a data center or inside of a broader server rack, you as that company might be able to increase that from $1 to $3. Has zero impact on the price of the server, but you just tripled your profits, right? Like it's pretty wild. And so it's chasing kind of the next point of constraint in the supply chain.
Okay, so let's pick up on that. As an analyst, as portfolio managers, the quest is always on for that next bottleneck. What is going to be that next thing that's really going to pop? How do you search for that?
Yeah, this is the beauty of being at Fidelity. We get great access to not just the company in question. We talk to its suppliers, its customers, their customers, their suppliers, and go all down the chain. We recently spent a week in Silicon Valley. So there was 20, 25 of us from our offices all around the world. So from Asia, Europe, here, went down to Silicon Valley, saw 20, 25 companies, and those spread from, you think, the big AI labs to the big chip companies to the chip suppliers and the suppliers of chip manufacturing equipment. So we get to see that kind of whole supply chain and have, discussions with them and say, where are you short? What's the biggest pain for you? What's keeping you up at night? And you kind of distill where there's pressure in the system.
I want to pick up on this trip that you just did to Silicon Valley. I'm assuming I wouldn't be invited to that, but that's something that Fidelity gives you access to, and it's a great clout. I was in San Francisco, though, about a month and a half ago for a conference, and I hadn't been in a decade, and it felt a bit like living in the future. It seemed very futuristic, being in San Fran. Because you were out there, I want you to address the question that many of our viewers probably have, which is, are we in an AI bubble? You were out there experiencing what these companies are thinking and doing. What are your thoughts on that?
Are we in an AI bubble? Full stop, no. That doesn't mean certain stocks aren't bubbly, right? On the show, I've talked about in the past, like the AI you use today will be the worst AI you ever use, in that it just keeps getting better and better and better, right? We go back even 6 weeks ago or 6 months ago. 6 months ago feels like 6 years ago at this point. The level of improvement we're seeing is just massive. And roll that forward. What does this look like in 2 to 3 years? The capabilities are going to be wild, and in some cases, maybe a bit scary. But I don't think the technology is in the bubble. Now, can industries that have historically been thought of as more commodity type businesses, memory is a good example, or the quintessential example there. Are we in a new normal for them where they're no longer a commodity? Or do we see the same cycle play out that we've always seen, in that somebody somewhere adds a bunch of capacity just at the wrong time, and we end up in a world of oversupply, and then prices come crashing down, and that's where you get kind of this bubble mentality.
There's a scariness to AI. As you said, whatever we're using today is the worst version we'll ever use, because it's going to get better every minute. Mm-hmm. There was a recent awards ceremony for mathematicians, Fields Medals, I think it was called. A number of people won, and one was a U of T professor, 37 years old or something. And he was pursuing a formula that I can't even conceive of. But he said, my next phase of life, I want to focus on how AI is used correctly and avoid it being used incorrectly. And it makes me think, OpenAI just had one of their models hack into another company, and they said, we didn't program it to do that. It just happened. Yeah. That's a scary sort of thought. What are your thoughts on that?
Yeah, so OpenAI's next gen model, so we don't know what it was, but we'll call it GPT-6 just out of convenience, looks like it broke out of its sandbox to try and it didn't do that maliciously. It did that because it was trying to solve a problem. And the easiest way to solve that problem was to break out of its sandbox, hack into another company that it thought would have the answer, and find that answer.
Which seems intelligent.
Well, it seems intelligent, laws maybe aside, and it's not the behavior you want to see. And they did have constraints around it. Those constraints just didn't work. So it's still very much, work in progress in terms of learning and containing these things. There will be some negative events going forward. This is a relatively benign example of something that could go wrong. It wasn't good, but damage-wise, it wasn't actually that.
It's an indicator, though.
It is, and we've seen the U.S. government put restrictions on what models can be released. Anthropic's top model is still heavily controlled. Only a certain number of companies have access to it. That is very regulated, very controlled because of this exact risk. That model, called Mythos, is very strong at cybersecurity issues. And of course, that can be used for both good or, more concerningly, if it gets in the wrong hands, to do a lot of damage.
I was reading recently about how Chinese models are distilling information from American models, I think through a mentee-mentor relationship, or there's some sort of hierarchy. And it creates concerns as far as, I guess, copyright, copying, what have you. What's happening with when you see the Chinese market and what's happening with AI?
Yeah, so I think we'll separate nation states from the discussion. I think all models probably distill from each other. There is a learning, right? It's how your brain works. I learn from you, you learn from me. Did I steal your information or not? TBD. I think there's a lot of people talking their own book, which they're completely right to do, in that if you are one of the closed source big AI labs in the US, less competition is better than more competition. Of course, you want to say what anyone else is doing is wrong. I think there's a broader debate around open models versus closed models. This is well proven out in software. The vast majority of software that runs in the world, the vast majority of servers run on open source operating systems. The vast majority of databases are actually open source databases, but the vast majority of dollars accrue to the closed sources, right? Windows has more revenue than Linux. Oracle has more revenue than open source databases. So it's this mix, and I wouldn't be too caught up on, say, where the token math is, right? Where the volume is versus where the dollars are. Remember, as investors, we follow dollars.
Okay, you used the word token.
Yep.
Token maxing. What does that mean?
Yeah, so a token is a unit of compute and is kind of become a unit of billing. Think of it kind of like a watt to electricity.
Okay.
It describes
it's a
something.
Unit of measurement.
A unit of measure. And so what actually is a token? Well, it's a fraction of a word. And of course, that doesn't mean much to most people. In a 100-word paragraph, there's about 75 tokens. So we can rationalize it with that. Models are priced both on input tokens and output tokens. Input being the prompt, output being the answer. Dollars per million tokens is kind of the order of magnitude that we're talking there.
Okay, so it's a way of billing. And is
Yep.
it true that some companies are saying, let's restrict the usage because we are token maxing and we don't want to spend at this stage the level that this may be leading us down the road to?
So token maxing, kind of the term to describe is using as many tokens as you can.
Mm-hmm.
A few of the big tech companies kind of got in trouble for putting up leaderboards internally of which employees are using the most tokens. I think well-intentioned at the time, right? We want to drive AI adoption. We want to show which of our employees are using AI well and support this. The problem is that leads to very bad behavior in that if I want to run that leaderboard, could say like, hey, every email that comes in, run an analysis on that email, write a dissertation on it, save it as a draft, and then delete that draft. That would use up a lot of tokens and creates absolutely zero value, but it burns a lot of money. Mm-hmm. So we saw a number of these companies have a bit of bill shock when their Anthropic or OpenAI bills came, and they said, well, we're spending too much money here. Let's rationalize some of that spend. That is completely normal, completely expected mm-hmm. behavior, and it's excitement ran ahead of value and probably expectations.
Okay, finding a point of equilibrium really is what they're doing.
Yeah, you want to find value.
Okay.
That's spending money for the sake of spending money is not a good idea.
I'd like to explore software. I believe you would suggest there's a divergence, in particular towards cybersecurity. And for our viewers' sake, for my sake, for your sake, for your family's sake, let's talk a bit about cybersecurity, because we were just talking about what economies can do, different countries and so on. There's even cyber warfare out there, but it's getting more and more precarious for consumers, for our clients, whose clients are calling them saying, I got this email or I got this video and it looks so real. Was it you?
Yeah.
Can you talk about that?
Yeah, so for much of the last year, software traded as a single basket. All the software was bad, was basically the answer. We've seen in the last several months, some divergence. You're seeing application software still kind of be a troubled spot, infrastructure software have a moment and really run, and cybersecurity software really run. Mm-hmm. Cybersecurity software started to run as stocks when we got word that Mythos was going to be very good at effectively cyber warfare. And so that means companies would probably need to pay more attention to this, probably have to spend more money. Mm-hmm. That's what's caused the run in those stocks. And the challenging part is people in general fall for some really basic stuff, right? Let's go back to the whole Nigerian prince trend.
You're dating yourself.
Yeah, well, yeah. I am old enough to remember that. Right? That was seemingly basic. Today, you still have people falling for all kinds of things like the IRS or the CRA has an overdue tax bill for you. You need to go to the store and pick up a bunch of gift cards to pay it. The world does not run on gift cards. If anyone's asking you to do that, it is a scam. Gift cards are a last-minute gift for someone that you forgot, not a way to do commerce.
But it's happening.
It is, and those are basic level things. What we can do with AI models is personalization at a mass scale, meaning that the attack could be very targeted to you or your company, and that makes it much more obvious. So I think, what can you do? Mm-hmm. One, make sure your systems are upgraded. And I don't mean buy a new system. I just mean install the latest software, install the updates, because the biggest risk point is outdated software with a known vulnerability.
Right. And
the second is just use some common sense, right? Like, this is hard, and I get it will look more convincing, but again, the world doesn't run on gift cards. No clicking that link will not result in Jeff Bezos sharing his fortune with you, right? Like, mm-hmm. basic stuff.
there used to be spelling mistakes and really bad logos, and they're much better now. So very hard to distill these.
Not just that, they've become too good, and now there's actually a company out there which layers on top of your AI to make the spelling and grammar worse. So it looks more human generated, which is a whole nother, nother world.
I'd like to talk about data centers. And I'm not sure if you've toured any or if that's what you did when you were in Silicon Valley. But the cost is immense. The public outcry is high, but the necessity is still there, isn't it? With all the videos people take. It's interesting that we were all taught about the cloud years ago. And so people actually, I'm sure, thought things were just stored somewhere up in space. But it's actually these big buildings that are in people's backyards, isn't it? And there's the need for more and more of them.
Yeah, so let's be very clear. Cloud, the internet, everything like that is just running on a data center somewhere. What you're seeing is the data centers get bigger, right? A gigawatt scale data center is now the level that we're talking about. That costs $40 to $50 billion plus to build. You need about 1,000 acres of land for that. Of course, the building takes up much less space, but cooling, power,
Generators.
Space, all of that, you need about 1,000 acres. What that means is you're not going to put one downtown Toronto, right? Like, I did the math last night. 1,000 acres is about 15 Yorkdale malls with the parking lots. Yeah. So that's a really big plot of land. This is why we're seeing these things go into like rural Texas, right? That and the Permian Basin also has a lot of gas. These use a lot of gas, so you want to be close to the pipelines.
Is there a fear about tapping into the electricity grid? For example, when the heat wave was happening here and then also through to the United States, there was a reduction in power needed from these centers because they needed to run air conditioning for people's houses and office buildings and so on. But these data centers are somewhat self-sufficient, is that true?
It's a mix. The older generation ones are probably connected to grid power. Meaning they'll use power from municipal power plants, that kind of thing. More and more we're seeing behind the meter power, meaning they're building their own power generation, whether that's gas turbines.
Satisfying a bottleneck, like you talked about.
And bottleneck gas turbines, right? These are the giant natural gas engines that produce electricity here. You're seeing now fuel cells and of course a push to nuclear. Nuclear takes a lot longer to build out than a gas pipeline and a gas turbine. But yeah, it's the data centers, as they've got bigger and as there's more pushback both from municipalities and from the public, they've become smarter about what they're building. So building their own power, not impacting grid prices. A lot of these used to be air-cooled and then water-cooled. That water-cooled used to just run through the water. So they would use a lot of water. Now, they're kind of closed-loop systems. So you fill it up once, and like a car radiator, a functioning car radiator, you're not adding water all the time to it, right? On an ongoing basis, they really don't use much water. That doesn't stop the narrative and from people who have their own agendas complaining, trying to get these things stopped.
Makes sense. And so the public outcry shouldn't be as vocal the way the new data centers are coming together.
I think there's good reason, like if you happen to have a house next to the data center in Abilene, Texas, you're probably not very happy, right? Because that wasn't there and now it is. So I can understand why you might complain about that. Complaining en masse that these things are terrible, I think is probably misguided or based off of prior knowledge or prior generations of data centers and what they used to do.
When you, as an analyst, are doing an analysis on stock valuations and so on, you're also looking at basket trades. You're doing fundamental analysis, but you're also looking at the quantitative side behind the scenes of how this all comes together. Can you talk about that, Ben?
Yeah, I mean, we try and look at everything, right? It's trying to be a sponge, pull in as much information as you can, and synthesize that into a result. The basket trade, or like this classification of AI winner versus AI loser, really matters because it speaks to positioning. And on a quarter, let's narrow this very close into a short time period. On a quarter, What matters is the numbers in the quarter, the guide, and positioning. You can have great numbers and a great guide, but if everyone already owned the stock, there's no incremental buyer, so the stock doesn't go up. Conversely, if everyone already owns it and you have a weak quarter, that's going to spell disaster. So understanding where investors are positioned is hugely important. It's been a bit of a one-way trade, right? Long hardware, short software, and short spenders. I mean, the guys were actually paying the CapEx dollars. But like we said earlier, you're starting to see some divergence within that. And that's an important realization. And understanding what can change the narrative. I always like to talk about narratives versus numbers. When those don't match, something's wrong, right? There's a great narrative, but the numbers aren't holding up. I'm not sure how durable that's going to be. Or where the narrative's very negative, but the numbers are quite positive. That starts to look very interesting as well. It's important to understand where the street is on both the narrative, what the numbers are looking like, and trying to find those mismatches.
So I'm going to make an assumption that this narrative to numbers component that you've just talked to us about, you've learned that through your time. You've learned that as a human being, as a test, as a litmus test, if you will, from the experience that you've had in the role that you're in. Can you talk about where you work AI into your life and the need for the human side of it as well?
Yeah, I mean, we've got one portfolio manager who has used AI to code a bunch of Python script to do data analysis on relative moves between stocks and how exaggerated or not those look. That might have used to be the realm of quant analysts. This is a fundamental portfolio manager who doesn't know how to code Python, but AI has done it for him. And it's coming out with some really interesting stuff that wouldn't have been possible before at that level.
So that was additive to their life.
Absolutely. And it's been an interesting signal because we were watching the divergence. So this is a lot of learned intuition. You can also just see it in the market. And that speaks to the baskets. But we were looking at the spread between those and saying, how exaggerated is this move that we saw over the last few weeks when software rallied and semi sold off? How stretched is that versus history? Is that fundamental analysis? No, absolutely not. But it gives a sense of how far this move has gone versus history.
I've got a question that's come in from a viewer, and this is not an answer that you're going to guarantee for the rest of the year, but it has to do with the volatility that we've seen, this correction, if some may phrase it that way, that we've seen in the tech sector. Do you expect that vol to continue, or should we see something more flatline? I guess they're saying has some of the stuffing been knocked out of the market and we should see some stability to the end of the year? Again, no guaranteed answers.
No, for my own sanity, I would love to say it's going to get quieter. I don't think it's going to, right? If we look from September of last year through till now, the IGV, again, a broad software index, declined 40% from the September peak through to its trough, rallied 45% from there, sold off 20-something% from there, and then rallied another 15% from there. That's a pretty sharp sawtooth pattern for a very diverse broad index of a bunch of big companies. That's been challenging. The number of days, I was looking at this the other day, the number of days where the SOX has moved more than 4%, either direction, used to be pretty rare. Now we're seeing it pretty frequently. And that just speaks, I think today's another day of minus 4% on the SOX. So it speaks to positioning, crowded trades, and when everyone's in one way and something changes, or even worse, you think something might change and there's a fear something might change, there can be a rush to unwind those positions. That means selling what's worked and selling where you are and buying what hasn't or covering those shorts. And that leads to these pretty violent swings. I think
to be expected.
Yeah, I think we'll see that continue as much as, ulcers and gray hair would prefer otherwise.
I appreciate and we appreciate the perspective on that question, but also on so much that we've talked about today. You've really given us a lot to think about on a Friday, and or whenever anybody watches this in the future. But wonderful perspective in an interesting market, and thank you for that, Ben Holton.
Thanks for having me.
Thanks for watching or listening to the FidelityConnects podcast. Now, if you haven't done so already, please subscribe to FidelityConnects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.